Hello and welcome to Metal Edge YouTube channel. Wishing you a happy new year filled with peace, good health, and endless smiles. May the new year bring you fresh hopes, bright days, and beautiful beginnings. In 2025, the precious metals market delivered one of its most remarkable years in modern history, with gold and silver posting their strongest annual performances since the turbulent inflationary era of the late 1970s. Gold surged approximately 65% to 70%, reaching all-time highs near $4,950 per ounce before closing the year around $4,300 to $4,350 amid year-end profit-taking and volatility. Silver, however, stole the spotlight with explosive gains of 150% to 175%, briefly surpassing $83 to $86 per ounce, its highest levels ever before pulling back to the $70 range as 2026 began. These rallies weren't mere speculation. They reflected a profound shift in global economics, where hard assets reclaimed center stage amid soaring debt, geopolitical tensions, and an unprecedented boom in industrial demand. To understand the magnitude of 2025's surge, consider the historical context. The last time precious metals achieved comparable annual gains was in 1979, when gold rocketed 126% and silver an astonishing 365%, fueled by double-digit inflation, oil shocks, and the Hunt brothers' attempt to corner the silver market. That era marked a crisis of confidence in fiat currencies following the end of the gold standard. Fast forward to 2025, and similar themes emerged: loss of faith in an endless money printing, ballooning global debt exceeding $324 trillion, and a weakening US dollar that fell nearly 10%, but with modern twists. This time, structural industrial shortages and technological revolutions amplified the moves, turning silver into a dual-purpose powerhouse, both a monetary hedge and an irreplaceable component in the green energy and digital age. The year started modestly, with gold around $2,600 per ounce and silver near $30. But by March, momentum built as central banks accelerated gold purchases, adding over 1,000 tons annually for the third straight year, a pace double the pre-2022 average. Emerging markets led the charge. China, India, Poland, Turkey, and others diversified reserves amid BRICS discussions of alternative currencies and US tariff threats. Poland alone added dozens of tons, pushing its holdings toward 22% of reserves. This official sector buying provided a solid floor, with net purchases in the first half of 2025 alone reaching 415 tons despite record prices. As spring turned to summer, industrial forces ignited silver's breakout. Solar photovoltaic demand exploded, consuming record volumes as global installations soared toward ambitious targets like the EU's 700 gigawatts by 2030. Each solar panel requires 15 to 25 grams of silver for its superior conductivity, and thriftiness efforts couldn't offset the sheer scale. Solar alone drove over 30% of industrial offtake. Electric vehicles compounded the pressure. A single EV uses 25 to 50 grams of silver, double that of traditional cars, in batteries, electronics, and charging infrastructure. With EV production doubling projections, automotive demand grew at a 3.4% compound annual rate through forecasts extending to 2031. Then came the AI revolution, an unexpected accelerant. Data centers and high-performance computing hardware rely on silver for contacts, conductors, and cooling efficiency. Global IT power capacity ballooned 53 times since 2000, reaching nearly 50 gigawatts in 2025, translating to massive hardware needs. Semiconductors, 5G networks, and advanced electronics further tightened supply. Industrial demand, accounting for over half of total silver consumption, hit deficits of 115 to 200 million ounces, the fifth consecutive year of structural shortfalls, as mine output stagnated amid environmental regulations, labor issues, and byproduct dependency from base metals. Geopolitics added fuel. US tariffs on Chinese goods disrupted chains, while conflicts in the Middle East and Eastern Europe spurred safe haven flows. China's December announcement of strict export licensing for silver, effective January 1st, 2026, sent shockwaves, requiring rigorous standards and limiting smaller producers. This policy, replacing quotas, aimed to retain metal domestically amid its own tech boom, exacerbating global crunch. Elon Musk publicly highlighted risks to supply chains, including Tesla's. Volatility defined the second half. Silver endured brutal swings, a 14% single-day plunge in late December, the worst in years, triggered by CME margin hikes forcing leveraged sales and thin holiday trading. Gold dipped below $4,000 briefly, but rebounded on ETF inflows topping $26 billion quarterly. Backwardation emerged with spot prices premium to futures, signaling physical desperation. Institutions demanded delivery, straining COMEX and LBMA vaults, yet fundamentals prevailed. The gold-silver ratio compressed from near 100 to the 70s-80s, reflecting silver's catch-up as undervalued industrial play. Mining stocks soared, GDX up over 100%, while cryptocurrencies lagged, with Bitcoin down as hard money rotated to tangibles. Human stories underscored the shift. Retirees saw portfolios preserved by bullion gains. Miners in Peru and Mexico navigated strikes amid shortages. Investors who diversified early reaped rewards, while late chasers faced whipsaws. Entering 2026 on January 3rd, prices stabilized. Gold near $4,811 to $4,343. Silver around $70 to $71. Analysts remain bullish. JP Morgan forecasts gold averaging $5,065 by Q4 2026. Goldman Sachs $4,900 end year. Silver targets range $70 to $100, with some eyeing triple digits if deficits deepen and ratio resets further. Central banks plan 755 tons in purchases, elevated despite higher prices, while industrial growth persists. Solar quadrupling, EVs overtaking combustion by silver use mid-decade, AI hardware exploding. Risks loom. Economic slowdown curbing industry, hawkish Fed pauses, or blow-off tops from euphoria. But structural supports, debt concerns, de-dollarization, tech indispensability suggest this metals war endures. Gold reaffirms as ultimate hedge, silver as growth proxy. For thousands of years, these metals endured crises, wars, empires' falls. In 2025, they reminded a digital world of their timeless value. As 2026 unfolds, with inventories low, demand relentless, and uncertainties mounting, the rally may evolve into a supercycle. Whether peak or prelude, precious metals have reasserted dominance in uncertain times. The question now, are you positioned for what comes next?
Beyond the price charts and headline numbers, the deeper implications of the 2025 precious metals surge lie in how fundamentally it reshaped investor psychology and global financial behavior. For years, gold and silver were dismissed by many as relics insurance assets rather than engines of growth. The events of 2025 shattered that perception. What unfolded was not merely a rally, but a reawakening of metals as strategic necessities in a world grappling with systemic fragility. Institutions that once held minimal exposure were forced to reassess allocation models, while sovereign entities openly questioned the long-term sustainability of reserve systems built almost entirely on fiat confidence. A critical shift occurred in how central banks approached reserve diversification. Unlike previous cycles, where gold buying was sporadic or symbolic, the purchases leading into and throughout 2025 were deliberate, coordinated, and persistent. Central banks were no longer just hedging inflation. They were hedging geopolitical risks, sanctions, exposure, and financial weaponization. The freezing of sovereign assets earlier in the decade had already planted seeds of distrust. By 2025, those seeds matured into action. Gold was not chosen because it promised yield, but because it promised neutrality, no counterparty risk, no political allegiance, and no dependency on digital infrastructure vulnerable to disruption. This shift was particularly pronounced among nations seeking to reduce reliance on the US dollar-based system. De-dollarization, once dismissed as rhetoric, gained tangible momentum. Trade settlements increasingly experimented with local currencies, commodity-linked agreements, and gold-backed clearing mechanisms. While no single alternative system replaced the dollar, the cumulative effect was erosion of its exclusivity. Gold benefited directly from this transition, serving as the bridge asset in a multipolar monetary landscape where trust was fragmented and alliances were fluid. Silver's ascent, however, represented something more complex. Unlike gold, silver straddled two worlds, the ancient and the futuristic. It carried monetary legacy while simultaneously underpinning the technologies defining the modern age. This dual identity made silver uniquely sensitive to both financial stress and industrial acceleration, as governments poured capital into infrastructure, electrification, and digital expansion. Silver demand rose not as a luxury, but as a necessity. Its role in electrification, renewable energy, medical applications, and advanced electronics positioned it as a bottleneck material in the global supply chain. What made the silver market particularly volatile was the inability of supply to respond quickly. Unlike oil or agricultural commodities, silver production is constrained by geology and economics. A majority of global silver output is produced as a byproduct of mining for copper, lead, zinc, and gold. This means silver supply cannot simply be increased in response to higher prices, unless base metal demand also rises sufficiently to justify expanded operations. In 2025, this structural limitation collided with soaring demand, creating a feedback loop where shortages intensified price movements, mining, investment, while increasing faced long lead times. From exploration to production, a new silver mine can take a decade or more to become operational. Environmental permitting, community opposition, water access issues, and geopolitical instability in key mining regions further complicated expansion efforts. Countries like Peru and Mexico, which together account for a significant portion of global silver supply, grappled with labor unrest, regulatory uncertainty, and social pressures that limited output growth. Even well-capitalized miners found themselves unable to scale production quickly enough to meet demand. The physical market began to reveal signs of stress that paper markets struggled to mask. Premiums on retail silver products surged globally, often diverging sharply from spot prices. Mints faced backlogs. Delivery delays extended from weeks to months, and secondary market liquidity thinned. Institutional buyers increasingly bypassed exchanges, opting instead for direct off-market sourcing and long-term supply contracts. These developments exposed the fragility of price discovery mechanisms reliant on leveraged futures markets rather than physical availability. Gold experienced similar, though less extreme, pressures. Vault inventories at major exchanges fluctuated significantly as delivery demands increased. Backwardation episodes, once rare in gold markets, became more frequent, signaling immediate demand for physical metal over future promises. These signals were closely monitored by sophisticated investors who understood their historical significance. In past cycles, prolonged backwardation often preceded major structural shifts in monetary systems or periods of acute financial stress. Investor behavior in 2025 reflected a broader reevaluation of risk. Traditional portfolios, heavily weighted toward equities and bonds, struggled to provide stability in an environment of rising rates, fiscal expansion, and geopolitical fragmentation. Bonds, long considered the anchor of conservative investing, failed to offer protection as inflation remained persistent and sovereign debt levels surged. Equities, while resilient in certain sectors, exhibited increased volatility and valuation concerns. In this context, precious metals re-emerged not as speculative trades, but as foundational assets. Retail participation played a notable role in amplifying price movements, particularly in silver. Social media, alternative financial media, and decentralized information networks accelerated awareness of supply constraints and industrial demand dynamics, unlike previous retail-driven episodes. However, the 2025 silver surge was not purely it was reinforced by data, visible shortages, and tangible industrial needs. This alignment of narrative and fundamentals lent the rally durability even amid sharp corrections. The role of exchange-traded products evolved as well. Gold ETFs experienced substantial inflows as institutional and retail investors sought liquid exposure without the complexities of physical storage. Silver ETFs, while also attracting capital, faced scrutiny over their ability to source sufficient metal during periods of intense demand. This scrutiny sparked renewed debate over paper versus physical ownership, with many investors opting to diversify across both to mitigate counterparty risk. Technological trends continued to reinforce metals demand beyond 2025. The global push toward electrification showed no signs of slowing. Grid upgrades, energy storage systems, and decentralized power generation all relied heavily on silver's conductive properties. Advances in battery technology, while reducing reliance on certain materials, did not eliminate the need for silver in power management and safety systems. Meanwhile, the expansion of artificial intelligence infrastructure required massive investments in data centers, cooling systems, and high-performance components saw areas where silver played a critical role. Medical and antimicrobial applications added another layer of demand resilience. Silver's unique properties made it indispensable in healthcare settings, particularly in wound care, surgical instruments, and infection control. As populations aged and healthcare systems expanded, this often overlooked segment contributed steadily to consumption, further tightening the supply-demand balance. On the monetary side, gold's relevance extended beyond price appreciation. It became a symbol of stability in an era marked by rapid technological change and financial experimentation. Central bank digital currencies advanced in several regions, raising questions about privacy, control, and systemic risk. Gold ownership both at the sovereign and individual level was increasingly viewed as a safeguard against over-centralization of financial power. By early 2026, The market entered a phase of consolidation rather than collapse. Corrections were sharp but contained, reflecting profit-taking rather than a loss of conviction. Volatility remained elevated, particularly in silver, but higher lows suggested underlying strength. Analysts debated whether prices had entered a secular plateau or were merely pausing before the next leg higher, while forecasts varied. Consensus acknowledged that the structural drivers supporting metals were not transient. Fiscal realities further reinforced this view. Governments worldwide faced mounting obligations, from aging populations to climate adaptation and defense spending. Servicing existing debt became increasingly challenging without continued monetary accommodation. This environment constrained policymakers, limiting their ability to pursue aggressive tightening without risking economic contraction. As a result, real interest rates remained subdued, a historically favorable condition for precious metals. Currency markets reflected these pressures. Competitive devaluations, while subtle, became more apparent as nations sought to maintain export competitiveness and manage debt burdens. In such a landscape, gold's role as a neutral reference point gained renewed importance. It functioned less as a bet against any single currency and more as a hedge against systemic dilution across all fiat systems. Silver's outlook remained more dynamic, shaped by both macroeconomic forces and technological evolution. Breakthroughs in efficiency and recycling offered potential relief, but scaling such solutions required time and investment. Recycling rates, while improving, were insufficient to offset demand growth, particularly as many silver applications dispersed the metal in forms difficult to recover economically. This reality ensured that primary supply constraints would persist. Market participants increasingly discussed the possibility of a long-term repricing of silver relative to gold. Historical ratios, long used as valuation benchmarks, were re-examined in light of silver's expanding industrial footprint. While no consensus emerged on a new normal, the debate itself underscored a recognition that silver's role had evolved beyond its traditional classification. The social dimension of the metal's resurgence also became more visible. In regions affected by inflation and currency instability, gold and silver ownership provided a measure of financial autonomy. Small-scale investors, particularly in emerging markets, turned to metals as stores of value accessible outside formal banking systems. This grassroots demand, though fragmented, contributed to global consumption and reinforced the metal's enduring relevance. As 2026 progressed, attention shifted from whether the metals rally would continue to how it would integrate into a restructured financial landscape. Rather than isolated spikes, gold and silver appeared increasingly embedded in long-term strategic planning by governments, institutions, and individuals alike. This integration suggested durability. Even if price trajectories remained uneven, the lessons of 2025 extended beyond markets. They highlighted the consequences of prolonged imbalances, the limits of financial engineering, and the enduring importance of tangible assets in a digitized world. Gold and silver did not rise in isolation. They rose because they addressed fundamental needs: trust, utility, and resiliency in a period when those qualities were in short supply. Whether the coming years would validate the notion of a full-fledged supercycle remained uncertain. What was clear, however, was that the precious metals of 2025 were no longer merely reacting to crisis. They were proactively shaping responses to it. In doing so, they reclaimed a central role that had been dormant but never obsolete. As the global economy navigated the intersection of technological acceleration and structural vulnerability, gold and silver stood as reminders that progress does not erase the need for stability. They bridged past and future, anchoring innovation to physical reality. In a world increasingly defined by abstraction digital assets, algorithmic finance, and virtual value, the return of precious metals signaled a recalibration towards substance. History suggests that such recalibrations are rarely brief. They unfold over years, sometimes decades, reshaping norms and expectations along the way. If 2025 marked the awakening, the years that follow may define how deeply that awakening transforms the financial order. The metals have spoken once again, not with nostalgia, but with relevance.